Hello everybody. So I want to briefly cover 3 stocks that dropped a lot after posting their Q2 earnings. And so we're in the aftermath now. Stocks are down. Are they a deal? Let's get started. So the first stock I want to talk about is Sezzle. Now, Sezzle was very much hyped up on X and everywhere, and everybody was asking me about Sezzle, and it looked good, but I thought it was expensive. It is now significantly cheaper than the rest of the sector. Affirm, PayPal, right? PayPal has a pay in 4 option, and of course Block, which owns Afterpay. So you have kind of the main players in the sector. Sezzle is the newcomer, is the faster growing company in buy now, pay later, and they grow the fastest out of all the sector. They grow the fastest. Of course, PayPal and Square, keep in mind they're diversified businesses, so they're not pure play. But even if you compare Sezzle to the leading pure play buy now, pay now company, which is Affirm, Sezzle grows, a good 70% faster. Sezzle also have better gross margin, and they have a better EBITDA margin. Rule of 40 is excellent at 107. Enterprise value over gross profit over earning growth is a 0.23. So the company is doing well, and the stock is down, a good 30 to 40%, depending on how far back you want to go. So it looks like a deal. It looks like the stock is cheap. But the better question is, do you want to invest in buy now, pay later? And I've made videos about this before. The disruption is the disruption of credit cards, the new generation Alpha, well, I guess they're a little young, but Generation Z mostly, they absolutely despise credit card. They grew up in an era where people don't like credit card. They've been told credit cards are bad, and so they are moving to this setup, to this system of pay in 6, pay in 8, pay in 4, and of course, how does that work? It's typically the retailer who will sponsor the interest rate for you. So the retailer will pay that very short-term interest rate for you. And so as the buyer, it looks like you're really paying only 0%. And they typically do that every 2 weeks because, of course, most paychecks in the United States, at least for non-corporate, like early job, your first job, etc. Most paychecks in the US, they tend to be every 2 weeks. Even sometimes corporate paychecks are every 2 weeks. So every 2 weeks really helps out a lot of these people who are new to the credit world because, they want to buy something. They put it in like pay in 6, and that's a period of 6 paychecks. Every 2 weeks a paycheck, and every 2 weeks you pay off the expense. And so, it's compelling to this generation. All I want to point out though is I find it a little strange, some of the things that they finance, and maybe I'm showing my age. Maybe I'm showing my I'm a later millennial, so maybe I'm showing my little bias because to me, if I'm gonna buy a hotel room or if I'm gonna buy an Airbnb, I'm just gonna pay cash for it. It's tough to imagine putting a Uber ride or a DoorDash order on buy now, pay later on DoorDash. So what, you order a meal and you pay it over like an 8-week period or a 6-week period. That's a little weird, but again, that's probably my generational bias speaking right there, and some people really love it. And after all, from an economic standpoint, if you are the buyer of this, from an economic standpoint, it makes sense. You still pay 0%, and so you're still. It's still advantageous from an economic standpoint. The key is psychology, right? Is this pushing you to spend more? Well, this is probably pushing people to spend much more money than they should. At least that's what the people who are wary of buy now pay later systems would say. So the question is like, do you have full control over your psychology when you spend money, right? That's kind of a big question. But there's no denying that the retailers have been loving this. Buy now pay later has allowed them to sell much more stuff, and Gen Z has been loving this. So it's not a question about Sezzle for me. Sezzle is clearly the cheapest play in the sector. To me, this is a question of, is this something that you want to be invested in? And there is also the concern of recession Every time you have a recession talk, people are saying, well, buy now, pay later is going to be impacted by a recession. I've heard that for like 3 years, so we'll see how that goes. I mean, at the end of the day, these are microloans, so it's I think it's much less detrimental than, say, like a credit card with 20% or 30% interest, right? I understand why this is resonating. To me, I see better deals in other sectors and in sectors where I don't have that question mark in my mind. But to me, Sezzle in the sector, probably the best player. Okay, looking at another stock, this one I own, this one I like very much, and that's LifeMD. LifeMD. So many of you in the comment section told me, you haven't covered LifeMD, you haven't covered LifeMD. Was because you didn't go on the channel, and if you go on the channel and you click on videos and you click on history, you can see that I did a full dedicated video for LifeMD. That's why I've done multiple videos since, and I'm not going to talk about LifeMD in every single video. I did a full video as soon as they released their earnings. They were dropping 32% in after hours. Well, it turns out the trading day was even worse because they ended up being nearly halved. Well, not quite, but almost. The stock dropped. The stock dropped minus 44% in that trading session after they reported earnings. To me, this was a clear overreaction, an absolutely clear overreaction, because a lot of that issue came with the ED segment, the LifeMD segment, which lost business. And this is the same as HIMS. HIMS had reported a day prior, and HIMS said also that they had a weakness in the ED segment. Now, LifeMD gave us information. They tweaked their advertising. They advertised different. They had a new strategy, new pricing, I think. I don't know if it's new pricing, but I would assume new strategy, and they fixed the issue, and they seem to be back to normal at LifeMD. I'm assuming HIMS is fixing that issue still. My guess is what happened in the ED segment is there must have been a really tough competitor who took a lot of share that quarter in Q2, and of course the branded GLP-1, the tone on the call is probably what led to a lot of the drop. The tone was not very good on that call when I listened to it. GLP-1, of course, LifeMD. They took they decided to go after branded GLP-1s. They decided to try to get you to qualify for a branded GLP-1 via your commercial insurance, branded GLP-1, and you go on LifeMD and you try to get a prescription for a branded GLP-1. Now, what they found out is commercial payers, commercial insurance, as the medical loss ratio has increased for the entire insurance industry, as we've seen, with companies like Oscar or UNH or Elevance, they have this increase in costs. So commercial payers are very quick to deny, and so LifeMD, even though they had a lot of people eligible for GLP-1 who came, they tried to get coverage for insurance, and then 3 weeks later, you find out insurance doesn't cover. And if insurance doesn't cover, not only LifeMD has to issue a refund, i.e., sorry, your insurance didn't cover, so you give the money back, but they also lose the customers, because the customers go to less scrupulous, I would say, makers of GLP-1s that are compounded GLP-1s, and I firmly believe HIMS does the GLP-1 compounding right, and they only do compounding for very legitimate reasons, because HIMS was not named in that lawsuit. But as you saw in that lawsuit from Novo Nordisk against a lot of lesser known compounders, there's a lot of compounders GLP-1s who will just compound GLP-1s just for whatever reason, and that, of course, is a patent infringement, and so that's why Novo is suing. And the problem is that Novo and Lilly, they kind of took like something of a playbook of Microsoft in the early days, right? So Microsoft in the early days, they went and they see Compaq, and they say, Compaq, you have to sell Microsoft software, otherwise we don't do any business with you, right? And so Novo and Lilly, they did the same thing to LifeMD and HIMS. They were like, okay, well, you have to stop selling compounded GLP-1s or we won't do business with you. LifeMD said, okay, we're stopping compounded GLP-1s. We stop. We're done. We only do branded GLP-1s. And now they're in this trouble with commercial payers not wanting to cover. And HIMSS took the other route. They were like, oh, no, well, the FDA has a clear carve-out for legitimate compounding of drugs, and so we're going to keep compounding in legitimate cases. And so, of course, because of that, well, HIMSS doesn't sell the branded medication anymore because of that. And so they're stuck selling things like liraglutide and oral weight loss pills like metformin, etc. Overall, I still think I still think that HIMSS has the better strategy, but LifeMD, given that it's half as cheap as HIMSS, it's much cheaper. It's 2x cheaper than HIMSS, and it dropped more. And it also has, a holistic EDC business segment. I'm fine having LifeMD kind of as an edge. I think LifeMD is heavily undervalued right now. This is to say the least, right? The stock was up to $15, and now it's back to $6, and I believe they have a compelling offer in their LifeMD Plus, where you get a doctor access for $19 a month, and you can get your prescriptions, you can get your refills. There's a lot of good things for LifeMD that they could emphasize on the call. Like they just launched their pharmacy, for example. They could have emphasized their partnership with lab companies. Like LabCorp, for example, they have a partnership where you can do a physical with LifeMD, and you can get your labs locally, and you can handle everything digitally. I think LifeMD has a lot going for it over than GLP-1, but they could have emphasized on the call, but they did not, because the market seems to only care about these two companies because of GLP-1s. Oh, and they have an exciting women's health product that's coming up. They bought a company for osteoporosis, and they're taking over that company, launching that business. Mental health, of course, anxiety, SSRIs, that's a thriving business that people tend to forget about that these companies have. HIMSS also has like a thriving SSRI business. Interestingly, LifeMD doesn't seem to be talking much about dermatology, so dermatology would be hair loss. I would have to see what RexMD has, but it's a holistic business. The business has been growing quite nicely. That forward revenue growth of 21%, of course, is being overshadowed by the fact that they have WorkSimpli, which is a slower growing segment, which kind of messes up the number. But if you remove WorkSimpli, you would find out that LifeMD's underlying telehealth business grows much faster than 21%. So I like LifeMD very much at these levels, and I am in the stock. I am holding the stock. Moving to the last one, and this one, I cannot understand. Oddity, I cannot understand how Oddity dropped 20% on everything amazing. Like their quarter was absolutely amazing. Everything was great. Il Maquillage is firing on all cylinders. Spoiled Child should be $1 billion brand by something like 2028. They're launching Brand Free. Brand Free is going to be a dermatology company that's like based on their AI expertise and prescription based. So Brand Free might be like a mini competitor to HIMSS and LifeMD. I don't know. We're curious about that. They're working on Brand 4 too, which is coming up. So this company as a legacy of already building two very successful brands. These brands are very successful on social media. Il Maquillage has a very, very sticky customer base. It's an AI company. Oddity is an AI-based company because Il Maquillage, you will remember, is an app where you can just answer questions and you can tell things about you, and so it matches the perfect color, the foundation color to your skin, and then women stick with it because it's like their perfect color. It's customization of cosmetics. It's an AI customized cosmetics solution. So innovative, right? Not what Elf is doing, not what any of the traditional things are doing. And the stock is growing revenue on all cylinders. It's profitable. The rule of 40 is through the roof at a 55, and their target is only a 40 or 40. Enterprise value over gross profit over revenue growth is cheap in my view. There's no issues with payers. There's no issues with insurance, and they have a buyback with $103 million remaining. So I cannot understand why this stock is down. And the buyback they've started, like, see, these are the shares outstanding. You can see, I expect in the next few quarters, as they execute their buybacks, you will have fewer shares. So I like Oddity Tech very, very much. I think this stock is cheap, and I think that sell-off was really unwarranted because I didn't see any red flags for them, and you know, I saw perhaps a yellow flag for LifeMD with the GLP-1 payers not paying. I saw a yellow flag here, you know. On Sezzle, to me, it's more of a sector that's holding me back. I'm not sure I want to be in that sector. It's maybe too specific. But anyways, so this is the aftermath of the sell-off. Up to you to decide which one you like, which one you don't like. This was not investment advice, not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe. Follow me on Patreon. Follow me on X. Thank you for watching, and have a wonderful, wonderful day.